Get your popcorn ready because today we're going to the movies. Yes, we're doing the AMC stock analysis. I'm putting my 10 steps, my 10 smart steps up against AMC today. I just asked you on the community poll on a couple of different stocks which one you would like me to analyze next. And y'all didn't want any of that. No, you commented below with AMC, AMC, AMC. So as always, ask and you shall receive. So today we're talking about AMC. Get ready and buckle up because this one's going to be interesting at the current moment. As we're talking here on this video, AMC is going under a short squeeze. So as some people like to call it, it's going to the moon. What was a $5 share price a little while ago, not that long ago, is now well over $50. And I bet as I continue to do this video, I'm going to see it continue to rise up and rise up. But for now, we're sitting at around $59 a share as of the time that I'm recording this. Who knows what it's going to be by the time the market closes tonight. Remember, as I said before, I don't always chase the share price because the share price can be awfully scary. So let's talk about AMC. Is this actually worthwhile buying into, either short-term or long-term and everything in between? So get that popcorn ready. You got your popcorn? Let's go. The first thing I want to clarify, if you're not familiar with a short squeeze and what's going on with AMC right now, it's very similar to what happened with GameStop back in January of 2021. A short squeeze is a very unusual condition that triggers a very high rising price in a stock or other tradable securities. So for a short squeeze to actually happen, it has to have an unusual degree of lots and lots of short sellers, usually hedge funds, holding positions in it. And the short squeeze begins when the price jumps higher than expected. And that condition plays out as a significant measure of those short sellers decide, hey, I'm going to cut my losses and exit the positions. And as they exit their positions to not lose any more money since they shorted the stock, it keeps pushing pressure up on that price. They sell out, it goes up. They sell out, it goes up. It makes them buy back the shares that they said were going to go down in price. Well, because all of the retail investors and the Reddit users and the Wall Street bet people are going in and pumping that price up, the hedge funds and the short sellers have to say, oh crap, if I don't exit my position by the time my short sale expires, I'm screwed. So I need to get out fast. But every time that they exit, and sometimes we're talking millions or billions of dollars, that pushes that share price up quite significantly. In fact, there has been a lot of different short squeezes over the period of time. Volkswagen just had a short squeeze just a few years ago. Of course, we had GameStop in early January, and now here we are on AMC. But the real question I want to bring up today is, should you invest in AMC? This video is for entertainment purposes only though. This is not financial advice because I don't know your particular financial situation. If you're worried, consult a financial advisor before making any investment decision. I'm going to talk through exactly what to look for in the 10 steps that I look at before I buy any type of share of stock. If you haven't seen that video before, if you want the full breakdown, link right up above. You can check that out and then go through the entire process to learn what I look at to make sure that the company is actually stable. What I don't want to do is buy into a share of stock that could eventually maybe go to the moon and then crash back down. Because what would happen to me, knowing my luck, I'm hanging on as the rocket ship's going up to the moon, but I failed to put my seatbelt on. And then all of a sudden, I end up in space and I'm just floating around outside in space because I was totally stupid and didn't look into everything that had to do with this thing that was going to the moon. And now that everybody's on the moon, I'm like in the middle of nowhere. Do you get what I'm saying? Like, I want to avoid that for you. So that's why you want to look at every angle of a stock before you buy in. So a lot of people like to buy into AMC because they're seeing this share price go up. Let's say you bought in at $5. Let's say you bought in when the stock was only $30. Right now, you're kind of excited. Oh my gosh, it's now up to $65.81. So you can see this keeps going up and up and up. The problem is nobody knows where it ends. Nobody truly knows where it ends. So you got to be careful. If you're investing money you don't have, you got to be careful about going all in on something like this. And then you were the fool that didn't put your seatbelt on the rocket ship going to the moon. And that price then says, oh, I reached the top and now it's time to fall back down. And if that happens, you're in trouble. So if you're only investing for the short term for that aspect, you got to be careful, guys, because that could mean that you get hurt. Now, if you're throwing in money that you don't really need and you're okay setting your money on fire, then that's okay. If you really want to get into something like that, that's totally your choice. But just be warned, you could get hurt. Let's start with smart step number 1 and put it to the test. I'm going to go over to seekingalpha.com as I always do, and I'm going to pull up my iPad screen and I'm going to show you AMC. We're going to walk through exactly how this works. So here we are on AMC. Like I said, the price now is at $66. Let's see. You can see the short squeeze began right about here. Right about at the low. 5:21 at 4 o'clock p.m. is where this started to happen, and here we are. We're continuing to go up, up, and up. Where it stops, nobody knows, and where it falls, oh God. So the very first smart step, we're going to go over to the dividends tab right here on AMC, and it says does not currently pay a dividend. So smart step 1 is looking at the payout ratio of a dividend if the company pays a dividend. In this case, it does not, but one thing to keep in mind, there is dividend history on AMC. In the good old days, they used to pay a dividend. Look at that. They used to pay about 20 cents every single quarter, and then they stopped that right around 2020, which of course we can blame the pandemic for that. So I'll give them a little bit of a pass, but I will say from the standpoint of dividends, they're going to get a yellow light out of my green, red, and yellow light theory. So it's kind of a caution. Yellow light, keep an eye on that, okay? Let's move on to smart step number 2, which is the PE ratio, price to earnings ratio. We want to make sure that this stock has runway. Some of the historical averages of the best growth stocks were right around 15 to 16. Anything below 20 is good, but of course we want it to be a positive integer, and this is where I get a little bit nervous, guys. Okay, here we are, and when you go on Seeking Alpha, you go over here to the right-hand side, and you're looking for this right here, PE ratio, but look, it has a nice, beautiful slash through it. What does that mean? That means it doesn't have a calculatable PE ratio, which means it's negative. And the thing that worries me about that is we're looking at earnings per share as well being negative at 3.36. Because of that, their price to earnings does not match our qualifications for a solid stock. So this gets a red light in smart step number 2. But remember, we got 10 total smart steps. And just because one of the smart steps is red does not necessarily mean it's a bad buy. But let's see what happens next. Third smart step, we want to look at the earnings per share versus the analyst. We want to make sure that are they beating analyst ratings or at minimum meeting what the analyst said they were going to do. Let's take a look at their earnings per share because we want to make sure we're making money on our money over the long period of time. We want to build that $1 million portfolio. In order to do that, we need long-term growth. So here we are. I'm going to scroll all the way down on seekingalpha.com as I showed you in the video that I made last week. So here we are on earnings per share, and right away, I'm a little bit scared. We are actually in the negatives. Look over here on this side. We have a negative situation going over here. -2, -4, -6, -8. That means negative earnings per share. You're losing money every share that you earn. So, and you can see the estimate indicated by the black is negative, negative, negative. So the analysts are basically saying, yeah, we're expecting this to be like not a good stock. And then you can see that, okay, Q1 2020, and that's before the pandemic. They were bad, but they weren't as bad as the analysts said they were going to be. And then in Q2, thanks to the pandemic, they were bad. You can see the blue line indicating that they were actually worse than the analyst thought they were going to be from an earnings per share perspective. We got Q4 looking kind of flat. Q1 even is looking kind of ugly. And then the analysts are still saying that we got some negativity going on in that aspect. So now this is on a quarterly basis. And you can see that right up here. It says period quarterly. So I also like to look at annual. How is it trending over the last period of time? So we can see in 2016, we did have a little bit of positivity there. So that's good news. But then look, from 2017 on, things just aren't looking too hot. Even though we beat analyst projections here in 2018, 2019 is looking bad. 2020, I'm going to put an X on that because again, the pandemic, I'll give them a little bit of a life for that. But the thing that concerns me, guys, is the fact that down here in the world of 2016, 2017, 2018, 2019, when the world was a little bit better, before we had to wear face coverings and freak out, that was still not too good. So guess what? Smart step number 3 also gets a red light. So we got a yellow, red, red. Fourth smart step, we got to look at the news. Now, right now, in the world of AMC, we're going to see news related specifically to the short squeeze. So what's happening here is, remember, the hedge funds are kind of jolted up against the fact that this company's not going anywhere. It's going down. And because it's going down, we're saying that we're going to make a ton of money if the price continues to drop. Well, the price isn't dropping. It's going up thanks to the retail investors. So that's what causes this whole short squeeze situation. So that's kind of scary. And that kind of sucks. Now, the cool thing about GameStop back in January is because of all those retail investors buying in, it gave GameStop a little bit more liquidity to be able to pay off some debt and really refocus their business. Could it do the same for AMC? That's where the fourth smart step comes in. We got to keep our eye on the news. What's going to happen with AMC? Not today, tomorrow, or next week. I'm talking about over the next month or 2 months, and specifically in the next quarter. What are we going to see on AMC that could be exciting? Now, what I want to say though, is we got our popcorn, we're going to the movie theater, and of course in 2020 that wasn't happening. They had to shut down due to the pandemic. But my concern would be, are we going to keep that same business model? Because I'm not too sure, and this is my own theory, but I'm not too sure people are going to rush back to the movie theater. I think people are going to be a little bit cautious, or potentially, to be on the other side of that, maybe the vaccinations will help people feel a little bit more confident and want to go back to the movies. But guys, we now have this beautiful opportunity to stream. And because we're streaming with all these different streaming services, they're now offering their movies on their specific streaming services before they even hit the movies. Or as an alternative to the movies, you can stream it with a little bit extra money. Disney Plus is a great example. They just released a new film that you can buy and watch in your own personal home movie theater. And if you get the right type of TV, I just got a 65-inch, man. It is so exciting. It's so sweet. And now I can take my streaming services and watch movies from the comfort of my home and buy cheaper popcorn, because you know AMC always jacks up the price on that popcorn. You know they do. That's got to be what I watch for. What's AMC going to do here? They're just going to go to the old school brick and mortar movie theater? Maybe that's cool, but is that the future of what was the drive-in movie theater? Are we going to see movie theaters go away in comparison to people staying at home and watching their movies on demand once they get released? That's what I got to keep an eye on. And when we look at the news, I want to see AMC respond to that kind of stuff. I want to see them take on the opportunity to maybe have an AMC streaming services that allows movies to come out on demand for maybe a premium price. That could be a differentiator in the business. And what I would then want to see is the revenues, their earnings, and everything in between respond positively to that. So for smart step number 4, because we're only talking about a short squeeze and there's nothing exciting, I'm sorry, I'm going to give them a red light for that as well. And I know you might not agree with me on that, but a short squeeze is such a temporary small thing. Long term, I need to see some news that's favorable for AMC before I get too excited about it. Let's move on to smart step number 5 and take a look at revenue growth. We want to see revenue growth continue to obviously grow over the long period of time. So I go to Seeking Alpha, I click on the financials tab, and I click on income statement, and here we are on that statement. Now I don't care too much about like 2012 and all that. You can see we got 2012, 2013. I don't care about that. And if you wanted to, you could upgrade on Seeking Alpha to see all that. But let's just look over the last couple of years. So we have revenues of $3 billion, $4 billion, that's good. $5 billion, looking even better. Okay, a little bit of a drop in 2019. And of course, 2020 stinks. So I'm going to put a square on that. And then trailing 12 months isn't looking too good either. So I'm seeing a little bit of revenue growth, but a downturn in 2019 and a slight dip in 2019. Now, I'm not going to rake them over the coals for that small little dip in 2019, but we got to keep an eye on it. This particular smart step, when it comes down to revenue growth over time, is going to get a yellow light, because I can't say it's red just because of 2020, but I'm going to say it's caution. You got to make sure that they're going to respond in 2021, 2022, and onward. I want to see that revenue continue to grow back up. Even if it grows up from 2020's low, that's okay. But I want to see revenue growth over the long period of time. If that doesn't happen, I got to get myself out of this stock. Smart step number 6, you want to look at the profit margin of the particular company. Now, profit is king. You want to make sure you're getting profit. If you're just making a bunch of revenue and it's all flying out the door, you're setting yourself up for future failure. So we want to look at our profit margin. And how we do that, it's a simple calculation. You take the net income of the company, divide it by the total revenue, and that equals the profit margin. So over in our world of Seeking Alpha, I'm going to go back here to my revenue stream. So I got 1074. And then 5,020. So let's do the 1074 first. So we take 1074.5, and then we hop over to the income statement, and we look at net income right here. Net income. Do you see that? Net income. And okay, I can't do it. I can't do it, guys. Look. We got a positive net income back here, but then look, negative, positive, negative, really negative, and somewhat negative. Even if I take 2019, I was about to say I'm going to do 2020 and then I'll give them some credit and do 2019, but 2019 also has negative net income. Guys, smart step 6 gets a red light. So we have 4 reds, 2 yellows. Let's move on to smart step 7. Smart step 7 looks at assets versus liabilities. We want to make sure they have more cash available than they do liabilities. It's just like your own home account. You want to have more money than you do debt. And if you don't, you need to get out of debt because you want to be profitable. You want to be a millionaire, right? You got to have more money to your name than you do debt to your name. And we certainly want to see that when it comes down to companies, because if we don't see that, we got to be a little bit worried that they can maybe not sustain their business. So right here in our Buddy Seeking Alpha, I'm going to go over to financials and I'm going to simply click on, once it loads, the balance sheet. There we are on the balance sheet. So we're going to look at assets first. I'm going to look at total long-term assets for this one. So scroll down here. Okay, that's total current assets, which is fine. But look here at total assets. Right now, if we look at 2020, we're at 10.2 billion, down from 13.6 billion in 2019. But that's okay. So let me write that down so I can make sure I keep note of that. So our total assets at 10.2 versus 13.6 billion. Okay, so if I go down to liabilities, we're going to look at the total current liabilities. And that is 1.5 billion. And then the total liabilities down here is for 2020 at 13.1 billion, and then the prior year 12.4 billion. All right, so now we got to look at this because we're looking at total assets of 10.2 and then 13.6 in 2019. If I go down here, I'm kind of screwed here a little bit. Now in 2019 I'm positive, but in 2020 I'm negative. Let me look back over the long period of time just to see how their balance sheet. So it does look like their assets were a little bit more than their liabilities, but they got impacted by the good old-fashioned pandemic. So I'm going to give them, you know what, I'll give them a pass on this, guys. For smart step 7, I'll go ahead and give them a green light because their assets are more than their liabilities, but with a word of caution, and this is where I'm kind of struggling with not giving them a yellow light on this, is the fact that in 2020 we are negative. We have more liabilities than we do assets with AMC, but whatever. We'll move forward from that and just deal with it because my hope would be they can go back to 2019 and figure out their debt, and maybe their short squeeze and all this money flowing in will help them. We'll have to see how they handle it. Next up, we want to look at ownership potential, and I know already this one's going to be interesting. Ownership potential tells you that you want to own more of the company. When you buy a share of stock, you become the owner of the company. And hey, as the owner of the company, you want to make sure you're making your money, right? You want to make sure your growth of your company is looking strong. If they're consistently issuing more common shares outstanding, that means that your ownership goes down. So you want as much as possible when it comes down to ownership. Think of it this way. You have 1,000 shares outstanding and you own 100 shares of AMC. That means you own 10% of the overall shares outstanding. But if the shares outstanding increases to 2,000, which means they've issued more shares to maybe pay off debt or fund more capital or whatever it can be, you're now only owning 5% of the company instead of 10% with your 100 shares. So I'm going to stick right here on this balance sheet section, right here, balance sheet. I'm going to scroll on down, and here's where we got, all right, I'm going to look at total common shares outstanding. Right there it is. So in 2016, we have 110. It goes up, it goes back down, it's kind of flat, and then it goes way up at 224.3, and then over the last 12 months, up to 450. So they're kind of like, they went like this. They went like, whoop, 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 whoop. So guess what? That means they get a red light because we don't like that. We don't want shares outstanding to continue to fly up to the world. That stinks. So here we are on step number 8. We got 1, 2, 3, 4, 5 red lights, 1, 2 yellow lights, and 1 green light. So do you see where I'm going with this? This is not looking good, my friend. It is not looking good. Let's go on to the 9th smart step, one of the most important ones, which we want to look at like our overall cash from operations minus capital expenditures. We want to see free cash flow growth, because when they have more free cash flow, they can buy back some of those shares that they issued, giving you more ownership potential. So yeah, let's just see what happens with this. This is what worries me a little bit. The free cash flow could also give them the opportunity to maybe invest in something like a streaming service, have that ability to future innovate. That's what I want to see in my companies. So cash flow over this one, let's see here. So here we are. I'm going to click. By the way, I'm clicking on the cash flow under financials on Seeking Alpha, scrolling all the way to the bottom. I'm looking at both levered and unlevered free cash flow. Look at the graph, by the way. It's like, that's all about 2020 again, of course. Okay, so here we got 174, 188, 204, 243, compared to 98, 17, 16, 56, and negative 938. So what I'll stick with is levered free cash flow. Again, the difference, by the way, if you're not sure what levered versus unlevered means, this means after they met their financial obligations. I want to see, after you got all your crap in order, what does the free cash flow look like? And so in this case, we're looking at that, at 98, 17, 16, 56. This actually, guys, again, I could see where you're looking like, oh, okay, give them some credit for the pandemic, but look at this over time. You're going from 98 down to 17, and that's from 2016 to 2017, and then down to 16 in 2018, and then you go up a little bit in 2019, so congratulations on that. But guys, I'm sorry. Red light on number 9. I just can't. I get the 938. Let's pretend 2020 doesn't exist. If 2020 doesn't exist, I'm still not happy with how this is progressing. I'm just not happy with it. That brings me to number 10. Smart step number 10. We want to make sure that the price to free cash flow is looking good. I'm looking at a market cap divided by the total free cash flow. I don't know. I think I don't know what to do because I'm looking at a negative number here. We're looking at negative 938. So I'll take 2019, for example. So that's 56 million. That's what we're looking at there. These prices are in millions. I'll take 2019. So 56 million is what we will need to divide the market cap by. So I'm going to go back here to the summary, and we're going to look over here to the market cap of 12.88 billion. So 12,880 divided by 56, because we need to divide this billions by millions. So if I take this and I take 12,880 divided by 56, that gives me 230. So lower numbers in this particular smart step usually indicates a company could be undervalued, but a higher number could indicate that the stock is relatively overvalued in relation to its free cash flow, and that's what we're looking at here. I'm looking at my calculator. I'm looking at 230. That is quite high. So for smart step 10, I think that they're quite overvalued when you look at it from that perspective, so that also gets a red light. So even if I go over to finance.yahoo.com where I'm at now, we can see, of course, here we are at 62. Uh-oh, is it going down? Nope. It's settled at 62. Okay. But if I over here, even their thing is saying overvalued. Again, that's a great way to capitalize on this and do your own math. Take the market cap, divide that market cap by the total free cash flow on the year that you're interested in. Of course, if we were divided against a negative free cash flow in 2020, that would look kind of messy. But if I just compare that to 2019, even though I know it's not apples to apples, it still is quite high, which gives Smart Step 10 a red light. So we got 1, 2, 3, 4, 5, 6, 7 red lights, 2 yellows, and 1 green. And that is that. I mean, that is just terrible. I think the popcorn is stale on this one, guys. I think the popcorn is stale on AMC. So what do you guys think? I mean, are you getting in on AMC because you're excited about the short squeeze? And I'm going to be honest with you guys, because I love to give you true love here. That's called gambling. So just be okay with it if you lose money on it. What are you doing? Comment down below. Let's have a chat. I know a lot of you are going to be like, yeah, but you're missing out on all this, to the moon stuff. But when I look at the overall long-term growth, because again, I want to build my portfolio for the long term. I want like that $1 million portfolio. In fact, if you look at millionaires' portfolios, they're not chasing meme stocks. They are building slowly but surely over time. And I'm not talking I'm 70 years old. Hell no. I'm continuing to earn more money. And as I earn more money, I take that more earnings and I put it into the stock market to accelerate my growth. I'm going to retire well before the average age of 65, and I'm going to retire a millionaire. And I want you to as well. So join me in the journey. Subscribe today. Here's some other videos you might find interesting. Stay tuned for the next analysis. And until next time, we'll see you on the next video.